No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to have some fun today. This is one of my favorite topics. Love talking about investing. As you know, you've been watching the show for a while. You know that big believer in modern portfolio theory about asset allocation being the biggest determinant of the return you're going to get on your portfolio, as well as the risk or volatility you're going to have in your portfolio as well. However, also acknowledging that things are changing, that their times are changing. Yes, what we see, in fact, is that, like today, we've got, of course, the pandemic that we've been dealing with for this past year and what effect it's had with regard to our world. Think in terms also of your financial planning and retirement planning, of course, and in particular, your investments. It's been a very, very volatile year, and we're seeing volatility, in fact, on the increase. So with these things changing, do we need to maybe think in terms of how we might need to change our planning a little bit? So we're looking at some alternative strategies that may be a good blend in with the asset allocation models I talk about, okay? So we're going to be talking about investing today, about how to get your portfolios in order, about how to adapt to this changing world. One of the things, for instance, is inflation. We're seeing higher inflation. Federal Chairman Powell has said, in fact, that they're going to let inflation continue to run because they're more concerned about jobs and the economy. So they're going to monitor, of course, but allow it to go up higher. And we're seeing that. So we need to adapt to that a little bit as well, make sure that our portfolios are able to stay up with this increasing inflation and, of course, cover taxes as well. This is going to protect our purchasing power over time. So we're going to get into investing. And today, to help me with that, is a good friend and special guest, Jeremy Rettich. Hasn't been on in many years. Really happy to have him on today. Jeremy's firm, Virtue Capital, is over in Brentwood. Great collaborators. We're putting together some plans for you to help you, in fact, improve your investment strategies as well. So, Jeremy, welcome to the show. Good to have you back on. It's been a very long time.
It has. Good to be here. Thank you, Hank.
And so much has changed since you were on last, too. And we're going to be talking today about, we talked about strategic, which I talk about all the time, of course, as far as asset allocation, the importance of that. But we're going to get into a couple new strategies, one of them being dynamic and the other tactical. And I'll let you talk briefly, if you like, on those two.
Yeah, absolutely. So strategic, or buy and hold, where you're just simply, which is very important and very traditional, where you're simply going in and rebalancing, usually on a quarterly basis, but you're staying the course, right? And you're just have many different assets that you're allocated to, but there's no really risk on or risk off, right? You just stay the course. Where dynamic, if you think of a light switch, one with a dimmer, where you turn the light on a little bit brighter and brighter, or dimmer and dimmer. Think of dynamic somewhat that way, and we'll dive into it more, but you can dial up risk or dial it down, meaning you can go more defensive depending on what's happening in the stock market and in your portfolio. And then tactical is more like a traditional light switch that's either risk on or risk off. So it can go defensive literally in a day and sell all equities and go into a defensive posture, whether that be in bonds or cash or some other asset class, depending on what the methodology of the strategy is. So very different when you go risk off than your traditional modern portfolio theory.
Excellent. And this is one of the things. You may even think there's a lot of ways this can be adapted in your own planning. So for instance, asset allocation could be a core model, right? This could be our core that we're building, and then we might want to add some hedging strategies. When we talk again about, would you agree, in fact, that times have changed? All right, when you look over the past, in particular over this past year, but in general, and are you going to continue, do you think these things are going to continue to change in the future? I know this is something that's been a topic of conversation for many over this past year. Are things ever going to get back to what we call normal? Think in terms of 9/11 and what happened then. Our world changed forever. Okay, this wasn't just a one-off event and that was the end of it. Think in terms of TSA and the way things have changed when you get on an airplane, for instance, to go somewhere, and other changes like the Patriot Act and how that affects our day-to-day living. So how is the pandemic going to affect it? What's going to be the new normal potentially going forward? So basically, Are things likely to continue to change in the future? What are your beliefs there? And then how confident are you that your plan, do you have a plan, okay, to adapt to this changing environment? So we're going to need to know, in fact, how to adapt and how we're going to manage risk. And managing risk is one of the biggest things we want to pay attention to protect ourselves in retirement in particular. You know, when you're working and you're putting money into your retirement accounts all the time, you've got time on your side and you can overcome some of these things, in particular, ride out volatility. However, okay, when you retire and you're on a fixed income, pension, Social Security, whatever you may have, even rental income, whatever other assets, a lot of that's going to be coming from your investments. So rather than pumping money into those investments, you're going to now start taking money out. And that adds, as you know, I've talked about many times, sequence of returns risk. It adds a whole new level of risk to your planning. So this is why it becomes more important than ever to adapt to this changing environment, in particular just with retirement alone and what that's going to look like. Let's take a look. In fact, investors need new strategies to manage risk during these unprecedented times, right? So current market risk, we've talked about. Stock market volatility has increased. The Federal Reserve slashing rates to zero. We've got very limited upside with bonds. Now, this is an area, in fact, that we're going to be looking to make some improvements on with regard to your planning, okay? How can you, in fact, adjust to a rising rising inflation rate environment coupled with the increased volatility. All right, we know that some traditional things that we might like putting money in CDs or in safe fixed type instruments, is not going to be enough. And then Jeremy, on this one, March 9th, 2020, I love this slide, was the 11-year anniversary of the stock market bottom during the financial crisis. That was going back to 09, and then, of course, at that time, of course, the market was dropping pretty dramatically last year at this 11-year anniversary. Did you see in your planning, Jeremy, when you were, as far as the investments and stuff, you talked about your the tactical one about on off, okay? How did that get employed during that time?
Great question, Hank. We saw a majority of our strategies that are on the platform that did go defensive. Some went defensive earlier on than others, but during that time frame, all of the dynamic dialed down risk and the tactical strategies went defensive, meaning they sold the equities or a portion of them and went defensive. And what we saw in 2020, just looking at some stats, according to Bank of America, and we all saw it happen, it was the fastest 30% decline in the history of the stock market. And that happened just after February 19th. In 22 trading days, we lost 30% in 22 trading days, which exceeded the fastest decline ever before, including 2008 and the Great Depression. And then you fast forward a few months later, right, on August 19th of 2020, the S&P 500 reached an all-time high, which was also the fastest recovery from bear market territory in the history of the stock market. So think about that. A lot of volatility, fastest 30% decline, fastest 30% recovery in the same year.
Yeah, isn't that amazing? And now that's volatility, all right? And this is what you'll recall, last year when we were going through that, and I was talking to you about this pandemic part and the effect that it's having at being more of a temporary effect rather than, this isn't like the previous bear markets that we've seen, okay? It was different because what caused it and the shutdowns and the different things that we did, it was like a self-inflicted wound in a sense, necessary things. Not to take away from that, necessary things, but at the same time, we were going to change those things and we would expect the rebound. It happened even faster and even stronger in terms of how we ended up the year than anyone expected. But in this regard, as Jeremy's talking about, one of the benefits of a tactical strategy is that if you think of doing an overlay, you could have an asset allocation model in your portfolio that would work as well. So Jeremy, as an example, you could have a strategic plan, but you can overlay this strategy you're talking about tactically that could also have that same effect where it could push you out. And when it pushes you out, it's basically taking you out of equities and into fixed, correct?
That's correct. So when you're risk on, in other words, you're invested in equities, right? You could have asset allocation, your traditional asset allocation, right? Mm-hmm. But unlike strategic or modern portfolio theory, where you stay the course 100% of the time, no matter what's happening in the stock market, no matter what's happening in your portfolio, you can go risk off. Sell a portion of your equities and go defensive, or depending if it's tactical, possibly sell 100% of your equities, going into what should be a safer investment for a period of time until you go risk back on, which you go back into your traditional asset allocation. Mm-hmm. So it's a way to be able to temper risk, and especially if there's a prolonged downturn in the stock mm-hmm. market, instead of trying to ride that out, which if you're near retirement or in retirement, dynamic or tactical may be something you want to consider for your portfolio for those reasons.
Okay, excellent. We're going to take a break. When we come back, we're going to delve into that a little bit more. We'll go a little deeper into both tactical. We'll talk more about strategic too and how they blend them together, but as far as tactical and of course dynamic, I want you to understand these concepts a little bit. We're going to, over the next coming weeks, we're going to keep going with this one, by the way. This is a topic that I want to hit you with more frequently, because it's one of the most important things. Your finances, your investments, that's the engine, the financial engine that's going to drive your retirement. That's going to be the difference between being able to thrive in retirement, right, to have fun, rather than just survive. All right, so we're going to get into that more for you right after this break. Join us here. We'll be right back on the Retirement Report.